Right now, as you watch this, your money is making money for someone else. That $5,000 sitting in your savings account, your bank has already lent it out 9 times over. And that's not illegal. That's exactly how the system is designed to work. Every time you deposit a dollar, you're not just storing it. You're fueling a massive financial machine that turns your money into loans, investments, and profits you'll never see. The question isn't whether your bank is using your money. The question is, how much are they making from it, and why are you getting almost nothing in return? Let's pull back the curtain on the hidden life of your bank account. The great illusion. When you deposit money into your checking or savings account, you probably think it sits there, safely stored in a vault with your name on it. But here's the truth that would shock most people. That money disappears almost immediately. Banks operate on a system called fractional reserve banking. This means they're only required to keep a fraction of your deposits on hand. In many countries, including the United States, as of recent years, that fraction can be as low as 0%. Yes, you heard that right. Zero. So where does your money actually go? The moment you deposit $1,000, your bank can legally lend out $900, $950, or even the entire amount to other customers. They're betting that you won't come asking for all your money at once, and statistically, you won't. Most of us leave our money sitting there, checking our balance on an app, completely unaware that the actual cash has been cycled through the economy multiple times over. This isn't fraud. This is banking 101, and it's been working this way for centuries. The money multiplication machine. Now here's where it gets truly mind-bending. Your $1,000 doesn't just get lent out once. It gets multiplied throughout the entire banking system through something called the money multiplier effect. Let's follow your deposit on its journey. You deposit $1,000 into Bank A. Bank A keeps $100 in reserve and lends $900 to someone buying a car. That person pays the car dealer, who deposits $900 into Bank B. Bank B now keeps $90 and lends out $810 to a small business owner. That business owner pays a supplier, who deposits $810 into Bank C. And on it goes. Your original $1,000 has now created $2,710 in the economy, and we've only gone through 3 banks. By the time this cycle completes, that single $1,000 deposit can generate $10,000 or more in total loans throughout the banking system. This is how banks create money out of thin air, and it's completely legal. But here's the kicker. While your money is being multiplied and lent out repeatedly, generating profit at every turn, you're earning maybe 0.5% interest per year. Meanwhile, the bank is charging 7% on auto loans, 15% on personal loans, and 20% on credit cards. That gap, that's pure profit. The real revenue streams. Interest isn't the only way banks profit from your account. In fact, for many banks, it's not even the primary revenue source anymore. Every time you swipe your debit card, the merchant pays your bank a fee, usually between 1% and 3% of your purchase. You buy a $100 pair of shoes, your bank just made $2 doing absolutely nothing. Multiply that by millions of transactions daily, and you're looking at billions in revenue. Then there are the fees. Overdraft fees alone generate over $8 billion annually for U.S. banks. Monthly maintenance fees, ATM fees, wire transfer fees, paper statement fees. Banks have turned nickel and dimming into an art form. And the customers who can least afford these fees, those living paycheck to paycheck, are the ones who pay them most frequently. But the really big money comes from something most depositors never think about: investments. Banks take your deposits and invest them in government bonds, mortgage-backed securities, and corporate loans. They're essentially running a massive investment fund using your money as capital, and you're an unpaid investor getting nearly zero return. Some banks even engage in proprietary trading, making bets in the stock market with depositor funds. When these bets pay off, shareholders and executives celebrate. When they don't, well, we saw what happened in 2008. The illusion of safety. Now you might be thinking, wait, isn't my money insured? Isn't it safe? And yes, in most developed countries, deposits are insured up to a certain amount. In the US, the FDIC insures up to $250,000 per depositor, per bank. But here's what that really means. Your money isn't sitting in a vault. It's been lent out, sometimes many times over. The insurance exists precisely because the money isn't actually there. It's a safety net designed to prevent bank runs, those panics where everyone rushes to withdraw their money at once. The insurance works because the government is betting that not every bank will fail simultaneously. But what happens when they do? In 2008, we came dangerously close to finding out. The entire global financial system nearly collapsed because banks had over-leveraged depositor funds into risky investments. Governments had to step in with trillions in bailouts, your tax dollars rescuing banks that had gambled with your deposits, and the system hasn't fundamentally changed since then. It's just become more complex, more difficult to understand, and more profitable for the banks. The alternative reality? So what's the alternative? Well, some people are finding one. Credit unions operate differently than banks. They're member-owned, nonprofit organizations. Instead of maximizing profits for shareholders, they return earnings to members through better interest rates and lower fees. But even credit unions operate on fractional reserve principles. Your money still isn't sitting in a vault. The difference is in who benefits from the profits generated. There's also the emerging world of digital banking and cryptocurrency, where some people are choosing to be their own bank. But that comes with its own risks and complexities. The truth is, for most people, traditional banking remains the only practical option. The real question is, should banks be required to be more transparent about what they do with your money? Should there be stricter regulations on how much they can lend out? Should depositors receive a fairer share of the profits generated from their funds? These are questions society is slowly beginning to ask. The hidden contract. Every time you open a bank account, you're entering into an unspoken contract. You're essentially saying, here's my money. You can use it to make more money for yourself. And in exchange, you'll keep it reasonably safe and give me convenient access to it when I need it. For most of history, this was a fair deal. Banks provided a crucial service, and their profit was reasonable compensation. But somewhere along the way, the balance shifted. Banks became too big, too complex, and too profitable. The gap between what they earn from your deposits and what they pay you has grown into a chasm. The average savings account in the U.S. pays about 0.4% interest annually. Inflation runs at roughly 3% per year. This means your money is actively losing value while sitting in the bank. Meanwhile, the bank is generating double-digit returns on that same money. You're essentially paying your bank to hold your money and make themselves rich with it. The banking system isn't broken. It's working exactly as designed. It's a system where depositors provide the capital, take on the risk, and receive the smallest share of the rewards. A system where the people handling your money profit enormously from it while you watch your purchasing power slowly erode. The hidden life of your bank account isn't scandalous or illegal. It's just radically unequal. And most people never realize it because the system is complex by design. Complexity creates confusion, and confusion keeps customers from asking difficult questions. Your bank account isn't a storage unit. It's an investment you're making in your bank's profitability. The question is, are you getting a fair return on that investment? Now that you know how the system really works, what will you do with this information? Drop a comment below and let me know. Do you think banks are giving us a fair deal, or is it time for change? And if you found this eye-opening, share it with someone who needs to see what's really happening with their money. Hit subscribe because we're just getting started exposing the systems that shape our financial lives.